Hi guys, for today we will have hybrid financing. The source of financing can either be debt or equity or anything in between. This lecture will be everything about anything in between debt and equity. So we're going to talk about preferred stocks, leases, warrants, and convertibles. These are sources of financing which cannot be clearly categorized as debt or equity. Let's start with preferred stocks. Preferred stocks are shares of stocks with claims to dividends and property that take precedence over those of the common shareholders. Generally, they earn a fixed dividend rate similar to coupon interest payments. Is preferred stock debt or equity? Actually, it is literally a hybrid between debt and equity. It is similar to debt in some respects and equity in other respects. Preferred stocks are similar to debt in that preferred stocks charge a fixed rate of dividends, similar to the way bonds charge a fixed coupon interest. Also, similar to debt, preferred stocks have no voting rights in the company's board. However, it is also similar to equity in a way that preferred shareholders cannot legally enforce payment of dividend, unlike when we talk about debt holders who can legally enforce this right for their coupon interest payment. Dividends are also not tax deductible, and generally, preferred stocks do not mature. A lot of preferred stocks are said to be cumulative preferred stocks. What does it mean? A cumulative feature of preferred stocks requires dividends not paid in the prior years to be paid to preferred stockholders before common share dividends are paid. That is, they should be paid first before the common shareholders will receive any dividend. These unpaid dividends, in case they accumulate, are called dividends in arrears. There are also preferred stocks which are said to have adjustable rates of dividend. Adjustable rate preferred stocks have dividend rates that are adjusted regularly, presumably depending on market conditions. Is it a good thing to issue preferred stocks instead of debt or instead of common equity? Well, there are advantages and disadvantages to issuing preferred stocks. Among the advantages include the non-payment of preferred stocks cannot lead to bankruptcy. In contrast with debt, failure to meet interest payments can mean insolvency. Instead of issuing equity, we can issue preferred stocks to prevent dilution of control so that the existing common stockholders will not have their control diminish. Also, if the preferred stocks have no maturity, it could reduce cash drain. Unlike in bonds, wherein you have to pay the entire par amount at maturity. Now, the disadvantages of preferred stock include the issuing company cannot claim tax deduction on dividend payments the way it can claim on interest payments, and they need to be paid before common equity dividends become payable, and thus the common shareholders will receive nothing unless you're going to pay the preferred stockholders first. So these are preferred stocks, literally a hybrid between debt and equity. Next, let's talk about leases. What is a lease? A lease is an agreement where one party agrees to grant the other party the rights to use his or her property for a consideration. Usually, this consideration is a stream of periodic payments. The parties to a lease are the lessee, the one who uses the property owned by the lessor, and the lessor, the party that owns the property. Why are leases popular? Traditionally, leases are ways in which companies can create an off-balance sheet source of financing. What does it mean? Leases will not show additional assets and liabilities in our balance sheet, but at the same time, the company can use the property. However, this is no longer the case. In the current international accounting standards as well as United States GAAP, the property under lease is required to be shown as an asset, and the lease payable is required to be shown as a liability in a similar way that we are going to purchase an asset by borrowing money. There are different types of leases. We have operating lease, where the lessor maintains and finances the property. A financial lease, where the lease is non-cancelable. It is as if it is let for most, if not the entire life of the property. Sale and leaseback, where the firm sells the property and leases it back for a specified period of time. If we are going to use debt, what is being shown in the balance sheet is the assets bought under the agreement, and the amount of payable will be shown as debt. However, when it comes to leases, it would be unfair if these items will not be shown because they are very similar to the way a bank borrowing is set up, similar to a mortgage payable. To give you a hypothetical case, let us proceed to the following. Moonlight Corporation needs a machine that will be used for the next 5 years, at which time the machine will become obsolete and have zero disposal value at the end. Moonlight has two alternatives available. One, buy the machine for a price of 1.5 million, borrowing the sum needed from a bank at an annual rate of 6%, or lease the machine with 5 annual lease payments of 340,000 pesos, first payment due immediately. We can actually compare these two options by looking at valuation principles. The value of an asset is the present value of the future cash flows it is expected to generate. In our case, we're going to value an asset of the lender or the lessor, depending on the scenario, which is basically a liability on the part of the company. Option 1, buy the machine, 1.5 million, paying 6% annually for the loan. We are going to have the following payments. 1.5 million times 6%, we are going to have payments of 90,000 every year for the next 5 years. In order to arrive at the present value of these future cash flows of 90,000 per year, we are going to use the present value of an ordinary annuity. 90,000 times the formula, you have 379,113. At the end of the borrowing period, the company is required to make the lump sum amount of principal, 1.5 million. Multiply this by the present value of a lump sum. So if we're going to look at the total obligation, we're going to have the sum of 379,113 and 1,120,887. We have 1.5 million. The present value of all future obligations, 1.5 million. This is what's going to happen if we are going to borrow the 1.5 million for 5 years and use them to purchase the equipment. But instead of literally buying the equipment, why won't we just lease the property? In this case, what is required of us is 5 payments of 340,000, first payment to be paid immediately. We have the following cash flows. Note that in this case, we are going to have the first payment immediately. That is in 0.0. Because of this, we're going to use the present value of annuity due. By multiplying 340,000 by the present value of an annuity due, we are going to have 1518 136. Comparing the two, we're going to borrow and buy the asset. We're going to have an obligation with a value of 1.5 million. While if we are going to rent, we're going to have 1518136 present value of obligation. It appears that it would be better to borrow and buy the asset outright with an advantage of 18,136, favoring the borrow and buy option. In this scenario, there are two things that I want you to notice. First, that it is actually similar if you're going to buy an asset by borrowing an amount from, say, a bank, and simply renting the asset for its entire life. As such, we can consider lease as an alternative source of funding. Second, based on our analysis, it would be better if we're going to borrow money from the bank at 6% and buy the asset itself. Now, let us consider taxes into the equation. Next sample case. Sunlight Company needs an equipment that will be used for the next 3 years, at which time the machine will have a zero salvage value. Sunlight Company is subject to an income tax rate of 40%. The two options are purchase the equipment for a lease price of 1.5 million, borrowing the sum needed from a bank at an annual rate of 10%, or lease the equipment with 3 annual lease payments of 600,000. First payment due a year after the lease. Before we compare the two options, I want you to notice the two. First, when it comes to our interest payment, interest can help us reduce our taxes. Because we're going to pay 10% interest, our taxes would go down. So effectively, we're going to pay only 10% times 1 minus 40%. That would give you 6%. This is our after-tax cost of debt. Second, if we own the property, we're going to show in our tax records that our property will be subject to depreciation throughout the useful life of the asset. So if we buy it at 1.5 million divided by 3 years, let's assume straight line depreciation, we will have a depreciation of 500,000. If this would happen, it would further reduce our taxes, giving us savings of 500,000 times 40%, which is 200,000. We call this the depreciation tax shield. Okay, let's compare. If we're going to use the borrow and buy option, we're going to have the following cash flows. 6% of 1.5 million, an after-tax interest of 90,000 per year. Because legal title will pass to the company, we can benefit from the declaration of depreciation, further reducing our taxes by 200,000. So this would be depreciation savings of 200,000. Lastly, the company will have to pay the lump sum payment after borrowing 1.5 million. So annually, years 1, 2, and 3, we are going to have a net benefit of 110,000. In year 3, however, there will be 1.5 million obligation to be paid. Using the effective rate of 6%, take the present value of this ordinary annuity, present value of 110,000, we are going to have 294.31 pesos. Present value of all 110,000s. Present value of 1.5 million. This would be an annuity lump sum. We have an obligation of 1259429. All in all, we have a net obligation of... Now, what if we are going to simply pay the lease payments? In this case, the first payment will happen a year after the lease has been signed. So we would have payments of 600,000 times 1 minus 40% equals to an after-tax rent expense of 360,000 pesos. Every year, starting year 1. And that is it. Multiply 360,000 by the present value of an ordinary annuity. We are going to have a present value of obligation. This time, it appears that it would be cheaper from the point of view of the company if we're going to rent instead of borrowing and buying. So we would have a difference of 3,114 favoring the lease option. In summary, taxes can affect our calculations in at least 2 ways. First, our cost of debt will be tax deductible because every time we pay interest, that's an expense. So our taxes will be lower, resulting to a lower effective after-tax interest. Because in the borrowing and buying option, we're going to show an asset in our balance sheet. This can be subject to depreciation. Depreciation can therefore reduce our taxes in what we call a depreciation tax shield, 200,000 in our example. There are other matters to consider when it comes to leases. First, does the asset have a residual value? This is the value of the lease property at the end of the lease term. So the issue is, when you're going to buy this property, you would be able to benefit from the residual value. But instead of buying, we're going to lease, this residual value will generally go back to the lessor. Also, another issue would be credit availability. If we use lease, credit availability may increase if it is not shown in the balance sheet. However, current accounting standards will no longer allow lease as an off-balance sheet item. Hence, this is no longer the case given the developments in the accounting standards. In our next video, we're going to talk about warrants and convertibles. So, please stay tuned. Like, share, and subscribe.